After spiking in February, gold has given back its gains and is now flat on the year. In fact, gold is down roughly 17% since peaking at a record high of nearly $1,900 an ounce last September. The downdrift comes as the outlook for inflation dims, the U.S. dollar has strengthened, and investors have become disappointed with a lack of further stimulus from the Federal Reserve. So where does the price of gold go from here? And should you be adding the metal to your portfolio? Joining me on the Wall Street Report Newsline now is Adrian Day, Chairman and Chief Executive Officer of Adrian Day Asset Management. Adrian, welcome.
Well, thank you.
What's your outlook for the price of gold?
Well, I think you mentioned the price of gold last year and in February and the declines we've had. And I think it's important to put this in context. I think gold was a little bit ahead of itself last summer. You know, we had deep concern about Europe at that time. The global stock markets were tumbling, and the dollar was also very low at that time. So you mentioned some of those things, and they've now corrected. But I think it's important to put it in a context. Gold was ahead of itself, and I think it's now come back to a much more reasonable value. You know, when you look at it, all of the reasons that people were buying gold, have been buying gold over the last 4 years since 2008, they're still intact. You know, people are still concerned about the monetary system. They're still concerned about the loss of purchasing value in their own currencies, and they're still concerned about their inability to earn a good return on simple deposits, whether it's bonds or CDs or in a bank. And so gold is still as attractive as it ever was.
What catalysts are you watching for gold now, whether it will drive the metal lower or higher?
I think what the gold market needs at this point is something new. And let's not forget that the summer months, June, July, August, are traditionally, they are a weak period for gold. So frankly, gold did decline from February, of course, but from the end of May, June, July, gold has actually performed much better this year than it typically does during the summer, when gold declines. So I think at this point, the gold market is really on hold. It's not really particularly weak. I don't think it's vulnerable to much further declines, but it's just on hold and it's waiting for something to happen. And what it's really waiting for is the Federal Reserve to act. I think the Fed really wants to preserve its keep its powder dry, if you like, until if things get worse in the United States. So I'm not sure we're going to see more stimulus from the Federal Reserve anytime soon. But what's very clear to me, is that if you look around the world at all the central banks we've just mentioned, it's almost inconceivable that any of those banks is going to start tightening soon. It's really a matter of how easy are they going to be, how much more stimulus is there going to be, and when is it going to come. But in the near future, tightening is out of the question. And that's all positive for gold.
So where do you see the price of gold actually going? We're sitting around $1,580 an ounce right now. You say the metal is sort of on hold, but as we move through the rest of the year, if things do worsen in Europe, as you mentioned, how much higher, for instance, would you see gold moving?
My sense is that gold will move up towards the end of the year. It might only move to 1650, 1700, unless we get some kind of stimulus from the Fed. If we get some kind of stimulus from the Fed, I think there's a lot of money on the sidelines waiting to get back into gold. The sentiment is pretty bearish on gold right now, or let's say it's as bearish as it ever is on gold, because generally the gold market is perennially bullish. But it's as bearish as it ever is. And so if we start to see gold move back up, I think there's a lot of money on the sidelines that will flow back into gold.
So how are you playing the gold space now? Physical gold, gold miners, ETFs? What would you recommend for investors?
Well, we pretty much buy everything. And I think there's two main factors that really determine what you should buy at any particular time. One is, what is your purpose in buying? What is your rationale? If you're buying gold or looking at gold as a very defensive asset for protection of your assets, you want to be buying gold bullion or bullion coins or an ETF. Or a gold bullion ETF like GLD, you certainly don't want to be buying consolidated moose pasture. Now, if you're looking to maximize your returns from gold because you think the price of gold is going up, then maybe you switch more to the gold mining stocks. Right now, in my view, the gold, although I'm buying gold bullion as well as the stocks, right now, to me, the stocks are just amazingly cheap. If you look at the XEU today, the XEU, which is the Philadelphia Index of major gold and silver miners, the XEU is actually fundamentally cheaper than the S&P today. I honestly can't remember the last time that happened. If you look at the TSX index of gold stocks, which is a much broader index, versus gold bullion itself, it's at the gold stocks are at a low relative to bullion that goes all the way back to 1986. Again, that's pretty astonishing when you think that gold stocks typically have leverage on an up market. So what I'm saying is that the gold stocks are just very cheap today. Just to name one, and it's an example rather than a recommendation. American Barrick, the largest gold mining company in the world, is trading at 7 times earnings multiple. It's got a better than 20% return on assets, a return on equity. It's got a super strong balance sheet with less than 20% debt to assets. That's very low for a gold mining company, which is a capital intensive industry, and 7 times earnings. This is cheap by anyone's standard.
Adrian, you said that's just an example. What about gold miners that you would actually recommend to investors to put their money in right now? Would you be willing to venture a couple of names?
Okay. I like Franco-Nevada a lot. That's a royalty company. It's by no means is Franco the cheapest of the gold miners, but in my book, it's the best quality. Super management, over $1 billion of cash on the balance sheet, no debt. So we like Franco, but we're also buying the big ones like Newmont, Barrick, Goldcorp, all of which are fundamentally cheap. But I'm also a big fan of the juniors. Again, if they're juniors that have strong balance sheets and are able to survive downturns and don't need to go into the market to issue dilutive equity. So I like a company, for example, like Virginia, which is a Canadian company. It's less than 300 million market cap, so it's a small one. But it's got $45 million of cash on the balance sheet. And it's not wasting that money, it's not spending that money aggressively, and yet it has a royalty on a mine that's starting in 2 years' time, that the net asset value of that is much more than the current market cap of the whole company. So we like things like that, where they have strong balance sheets and they have assets that will produce revenue at some point.
Adrian Day, CEO of Adrian Day Management, thanks very much for being with us.